These three chart patterns are used by every professional crypto trader to identify high probability setups. And here's the crazy part. They are so simple that once I show them to you, you'll start seeing them everywhere. Most crypto traders spend years trying to learn dozens of complicated indicators and strategies, but the truth is, mastering just these three patterns is all you need to consistently identify profitable opportunities in crypto. By the end of this video, you'll know exactly what to look for, when to buy, when to sell, and how to manage risk like a professional trader. Here's a fundamental truth about crypto trading. You can have the best fundamental analysis, know every project inside and out, but if you can't read charts, you'll struggle to time your entries and exits effectively. Charts tell you the story of human emotion, fear, greed, panic, euphoria, and these emotions create predictable patterns that repeat consistently across all time frames. The difference between profitable traders and everyone else isn't intelligence or luck. It's the ability to recognize these patterns and act on them with discipline. Professional traders focus on just a handful of high probability setups rather than trying to trade everything they see. These three patterns we're about to cover form the foundation of technical analysis and are used by institutional traders and retail professionals alike. Before we dive into the patterns, you need to understand what price action actually is. Every candle on a chart tells a story. Support and resistance. These are the most important levels on any chart. Support is where buyers tend to step in. Resistance is where sellers typically take control. Think of them as psychological battlegrounds where supply and demand clash. Volume. This confirms price movements. A breakout with high volume indicates strong institutional interest. Low volume breakouts often fail quickly. Market structure, higher highs and higher lows indicate an uptrend. Lower highs and lower lows signal a downtrend. When this structure breaks, it often signals a trend change. Understanding these concepts is crucial because our three patterns are built on these foundation principles. Let's examine how these work on historical chart examples. The bull flag is considered one of the most reliable continuation patterns in technical analysis because it represents a healthy pause in an uptrend. What it looks like after a strong upward move, the pole, the price consolidates in a tight range or slightly downward channel, the flag. This creates a visual that resembles a flag on a pole. Psychology behind the pattern. The initial move up attracts buyers and creates momentum. The consolidation phase represents profit taking by early buyers, but the underlying demand remains strong. This creates the setup for another leg higher. How professional traders approach it. Entry. Look for a breakout above the flag's upper boundary with increased volume. Target. Measure the height of the pole and project it from the breakout point. Stop loss. Place below the flag's lower support level. The key to trading bull flags successfully is patience. Wait for clear confirmation rather than trying to predict the breakout. Volume is your best friend. Without it, many breakouts fail. Let's examine some textbook examples of bull flags on major cryptocurrency charts to see how this pattern develops in real market conditions. The ascending triangle is a powerful continuation pattern that often precedes significant breakouts to the upside. What it looks like, price repeatedly tests the same resistance level while making progressively higher lows, creating a triangle shape that's flat on top and rising on the bottom. Psychology behind the pattern. Each test of resistance shows that buyers are becoming more aggressive, willing to pay higher prices. Meanwhile, sellers are becoming less aggressive, not pushing price as low on each pullback. This creates a coiling effect that eventually leads to an explosive move. Professional trading approach. Entry. Wait for a decisive break above the resistance level confirmed by volume. Target. Measure the height of the triangle at its widest point and project it from the breakout level. Stop loss. Place below the most recent higher low in the pattern. The critical factor is patience. Many traders jump in too early, trying to anticipate the breakout. Professional traders wait for clear confirmation with volume before entering. Common characteristics of successful ascending triangles include at least two touches of the resistance level, a minimum of two higher lows, and a duration of several weeks to several months. Let's analyze how this pattern has appeared historically in major cryptocurrencies and examine the key features that make some breakouts more successful than others. The double bottom is one of the most reliable reversal patterns, signaling a potential end to a downtrend and the beginning of an upward move. What it looks like: price declines to a significant low, bounces higher, then declines again to test the same low level or very close to it, before bouncing again. The pattern resembles the letter W when complete. Psychology behind the pattern: the first decline represents selling pressure reaching a climax. The bounce shows that buyers are willing to step in at that level. The second test proves that sellers are exhausted. There's insufficient selling pressure to push price lower. This creates the foundation for a reversal. Professional trading methodology. Entry: look for a break above the middle peak, called the neckline, with confirming volume. Target: measure the distance from the lowest point to the neckline, then project that distance upward from the neckline. Stop loss: place below the second bottom, giving some room for false breaks. Key validation factors include: the second bottom should ideally be on lower volume than the first, showing less selling pressure, and there should be some form of bullish divergence on momentum indicators. The pattern typically takes several weeks to months to develop fully, and patience is essential. Premature entries often result in getting caught in the final leg down. Let's examine historical examples of double bottoms in cryptocurrency markets and identify the key characteristics that separate successful reversals from failed attempts. Chart patterns are only valuable when combined with proper risk management. Here are the fundamental principles every trader should follow. The foundation: never risk more than you can afford. A common rule among professional traders is the 2% rule. Never risk more than 2% of your total portfolio on any single trade. This ensures that even a series of losses won't devastate your account. Risk reward ratios. Before entering any trade, identify your potential profit target and your stop loss level. Professional traders typically look for trades that offer at least a 1.2 or 1.3 risk reward ratio. Meaning, if you're willing to lose $100, you should have the potential to make $200, $300. Position sizing calculation: to determine the exact amount to invest in each trade, use this formula. Account size x risk percentage. Entry price, stop loss price. Position size. Professional money management principles: scale into positions rather than going all in at once. Take partial profits at predetermined targets. Move your stop loss to break even once the trade moves in your favor. Keep detailed records of every trade to track your performance. Understanding these concepts will help you stay in the game long enough for your pattern recognition skills to generate consistent returns. Understanding common pitfalls is just as important as learning the patterns themselves. Here are the most frequent mistakes traders make with chart patterns. Mistake number 1: trading patterns in choppy, sideways markets. These patterns work best in trending markets. In sideways, range bound conditions, false breakouts are much more common. Mistake number 2: ignoring volume confirmation. Volume is the fuel that powers breakouts. Patterns that break without volume support often fail quickly and reverse. Mistake number 3: setting unrealistic profit targets. While it's exciting to imagine massive gains, setting targets that are too ambitious often leads to missed opportunities when reasonable profits are available. Mistake number 4: moving stop losses against your position. Once you set a stop loss based on technical levels, don't move it further away from your entry just because the trade isn't working. This destroys your risk management. Mistake number 5: trying to trade every pattern you see. Quality over quantity is key. It's better to wait for high probability setups that meet all your criteria than to trade mediocre patterns. Learning to avoid these mistakes is often more valuable than learning the patterns themselves, as it's the difference between consistent profitability and boom bust cycles. If you want to master crypto chart reading, here's what you need to do right now. First, subscribe and hit the bell because I post new chart analysis and trading tutorials every week. Second, I've created a complete chart reading cheat sheet that includes all three patterns: entry, shorts, exit rules, risk management formulas, and a practice checklist. You can download it free using the link below. Third, start practicing. Open up TradingView and start looking for these patterns on different crypto charts. The more you practice identifying them, the faster you'll spot opportunities. And finally, let me know in the comments which pattern you're going to focus on first. I read every comment and I'll give you personalized tips based on your experience level. Remember, successful trading isn't about being right all the time, it's about being consistently profitable over time. These three patterns, combined with proper risk management, will give you a massive edge in the crypto markets